Bitcoin just dropped below $64,000. Ethereum is trading at 4,830. And while retail investors are panicking, one institution quietly bought $101 million worth of Ethereum in a single week. Something massive is happening beneath this crash, and most people are completely missing it. Welcome to the Market Flux. If you are new here, I break down what is actually happening in markets while mainstream media keeps you distracted. Subscribe right now, because what I am about to show you today involves a $121 trillion wipeout and a hidden accumulation play that could change how you see this market. Let us start with exactly what happened on February 24th, 2026. Bitcoin is trading below $64,000 this morning in the Asian session. That is a 42% decline from its October 2025 peak of 126 to 272. In 139 days, the entire crypto market has shed $1.21 trillion in value. Bitcoin Cash is among the top losers right now. BCH is extending losses alongside Hyperliquid and Pump.Fun. The broad altcoin market is bleeding out. And Hedera, H/R, is trading below $100 today. That is, after falling nearly 4% in the previous 24 hours. On-chain data, derivatives data, and technicals are all pointing the same direction, down. This is not a small dip. This is a coordinated system-wide sell-off. Now here is where it gets interesting. Bitcoin's slide on February 23rd was not random. On Saturday, February 22nd, President Trump announced he was raising global tariffs from 10% to 15% under Section 122 of the Trade Act of 1974. Markets opened Monday, and the reaction was immediate. Bitcoin slid 4.5% in just 2 hours. Open interest dropped to $19.5 billion, well below the 2026 peak of $38.3 billion. In 60 minutes, after Bitcoin broke 65,000, $230 million in leveraged long positions were liquidated. Total crypto liquidations in the past 24 hours hit over 458 million, and 92% of those liquidations were longs. Think about what that means. The people betting on price going up got destroyed in under an hour. Now here is the mechanism most people are not understanding. Think of leveraged crypto trading like a house of cards on a table that is already tilting. When tariff news hit, someone kicked the table. The cards did not fall slowly. They all collapsed at once. Every long position that got liquidated forced exchanges to sell more Bitcoin to cover losses. That selling pushed prices lower. Lower prices triggered more liquidations. It became a cascade, self-reinforcing, automatic. This is why you saw $2.56 billion in positions liquidated on February 5th alone, during the earlier flash crash that sent Bitcoin to $62,700, and why the pattern is repeating now. There are 3 reasons this crash is happening, and they are all connected. Reason number 1 is institutional money reversing direction. Bitcoin ETFs, which were buying 46,000 Bitcoin this time last year, are now net sellers in 2026. Since October 10th, 2025, spot Bitcoin ETFs have seen $8.5 billion in net outflows. Ethereum ETFs lost $123.3 million just last week. When institutions sell their ETF shares, fund managers are forced to liquidate the underlying crypto. That creates a continuous automatic source of selling pressure that retail buyers simply cannot absorb. Reason number 2 is the Sell America macro trade. Bitcoin's increasing integration into the U.S. financial system through ETFs and institutional accounts has made it vulnerable to the same forces crushing U.S. equities. As investors flee from U.S. assets because of tariff-induced inflation fears, they are selling Bitcoin alongside the S&P 500. The very institutional adoption that was supposed to validate Bitcoin has now chained it to the U.S. economy. Gold is up 20% year to date. Bitcoin is down 24%. That contrast tells you everything about the current macro environment. Reason number 3 is Ethereum specific, and it is brutal. Ethereum's own co-founder Vitalik Buterin sold 1,869 ETH, valued at $3.67 million in just the past 2 days. Before that, he sold 6,158 ETH worth $14.78 million. And during that sale, Ethereum dropped 22.7%, falling from 2,060 to 1,825. The market reads founder sales as a signal. When the person who built the network is selling, it triggers additional fear and accelerates the move lower. Now, here's the part that mainstream media is completely ignoring. While retail investors are panic selling Ethereum at 130, Bitmine Immersion Technologies purchased 162 ETH last week. That was its largest single purchase since December. Their total Ethereum holdings now stand at 4,122,659 ETH, worth approximately $8.4 billion at current prices. They are sitting on unrealized losses of over $8 billion, and they are still buying. Let that sink in for a moment. While you were watching the price drop and feeling sick, an institution backed by Peter Thiel's Founders Fund and Cathie Wood's ARK Invest was deploying over $100 million into Ethereum at these exact prices. The exchange whale ratio for Bitcoin has hit 0.64, its highest level since 2015. That means the top 10 deposits now account for 64% of all Bitcoin flowing into exchanges. Big holders are sending Bitcoin to exchanges. That is typically a signal of selling intent from the largest accounts in the market. But here's the contradiction. Publicly tracked smart money like BitMine is accumulating ETH at the same time whales are dumping BTC. Two very different strategies happening simultaneously beneath the surface. Most retail investors see one number, the price going down, and react to that alone. They are not asking who is on the other side of their panic sell. They are not asking why an institution willing to absorb an $8 billion paper loss is still adding more. They are not asking what these buyers know that the sellers do not. Fundstrat analyst Sean Farrell released a report last week using on-chain realized price data. Ethereum is currently trading 22% below the average cost basis of all investors. That figure is close to the implied lows seen in 2025 at 21% and in 2022 at 39%. Farrell's model gives ETH an implied 12-month return of 81% and an 87% historical win rate from this level. The fear and greed index is at 11 out of 100. That is extreme fear. That is the same reading historically associated with market bottoms, not tops. But here is where most people completely miss the full picture. And what the next phase of this market could look like is something almost nobody is talking about right now. Let us go back to May 2022. Ethereum was trading at $1,700. The fear and greed index was at 8. Luna had just collapsed. Celsius was freezing withdrawals. Every headline said crypto was finished. 12 months later, Ethereum was trading at $2,100. 18 months later, it hit $4,000. The pattern right now is nearly identical. A macro shock, a leverage flush, whale outflows, extreme fear readings, and quiet institutional accumulation at depressed prices. February 24th, 2026 looks almost frame for frame like May 14th, 2022, the day before Ethereum's multi-month base began forming. History does not repeat exactly, but it rhymes with remarkable precision. Now let us talk about what has not changed, because this is critical. Structural factor number 1, central banks and sovereign funds are not exiting crypto, they are repositioning. Abu Dhabi's Sovereign Wealth Fund disclosed a $436 million Bitcoin ETF position in Q4 2025. Norway's Norges Bank holds indirect exposure through MicroStrategy shares worth over 600 million. These are not retail traders. These are multi-generational capital managers. They do not exit in a panic. Structural factor number 2, Ethereum's supply is still deflationary. Since the merge in September 2022, over 1.6 million ETH has been permanently burned. Every transaction on the network removes ETH from circulation. Even at today's reduced gas fees, the deflationary mechanism is intact. Supply is not growing. Demand will not stay suppressed forever. Structural factor number 3, Hedera's real-world adoption is accelerating despite the price drop. HBAR is integrated into 28 enterprise use cases, including Google Cloud, ServiceNow, and the HBAR Foundation's payments infrastructure. The price of HBAR at $0.103 does not reflect its network usage. Transaction volume on Hedera actually increased 11% in January 2026, while the token price fell 34%. Price and fundamentals have completely disconnected. Structural factor number 4, Bitcoin dominance is currently rising. It hit 62.4% this week. Historically, when Bitcoin dominance peaks and then rolls over, altcoin season begins. Bitcoin Cash, Hedera, and Ethereum typically outperform during those rotations. The conditions for that rotation are building right now beneath the surface. Now I am going on the record. Screenshot this. By June 30th, 2026, Ethereum will trade above $3,200. Here is the basis for that call. ETH is currently 22% below its realized price baseline. Fundstrat's model shows an 87% historical win rate for 12-month returns from this exact level. BitMine's 4.42 million ETH position creates structural buying demand, and the Ethereum protocol upgrade, Pectra, scheduled for Q1 2026, is expected to meaningfully increase validator yields, which will incentivize staking, reduce liquid supply, and create upward price pressure. The combination of technical catalysts, institutional positioning, and historical pattern puts $3,200 as a conservative target by end of Q2. Now let us look at 3 scenarios and their probabilities. Scenario 1, probability 55%. Bitcoin stabilizes above $62,000, tariff fears peak in March, and the macro environment softens as the Federal Reserve signals rate cuts in Q2. Ethereum recovers to $3,200 by June, Hedera climbs back above $0.18, and Bitcoin Cash returns toward 380. This is the base case. Scenario 2, probability 30%. A second tariff escalation hits. In March, Bitcoin breaks below $60,000 and tests $55,000. Ethereum tags $1,500 before recovering. The recovery still happens, but the timeline pushes to Q3 2026. Hedera falls to 0 to 0.07 before stabilizing. Scenario 3, probability 15%. A black swan event on a major exchange failure, a geopolitical escalation, or an aggressive Fed policy mistake sends Bitcoin toward $48,000. A full bear market resumes. Recovery is delayed until 2027. This is the tail risk. It is real, but it is not the base case. Now let me speak directly to you based on where you actually are right now. If you are holding physical Bitcoin or Ethereum in cold storage, you have already survived the worst of the shakeout. The people who panic sold at $64,000 locked in losses. You did not. Hold your position. Do not add leverage. Your patience is your strategy. If you are trading with leverage, reduce your position size immediately. At a fear and greed index of 11, volatility is unpredictable in both directions. A 20% bounce can happen as fast as a 20% drop. Leverage cuts both ways. The data does not support aggressive leverage longs until Bitcoin reclaims $68,000 on strong volume. If you are sitting on cash and have not entered yet, this is the environment where cost averaging begins to make sense, not a single large entry. Spread purchases across February 24th, March 15th, and April weren't. You do not need to catch the exact bottom. You need to avoid catching the exact top. Dollar cost averaging is not exciting. It is effective. If you bought at the peak, near Bitcoin's $126,272 high in October 2025, understand that you are not uniquely unlucky. Every major crypto cycle has produced exactly this type of drawdown. Bitcoin fell 83% in 2018. It fell 74% in 2022. Both times, 4-year holders were made whole and then some. The duration of pain is the price of the recovery gained. Now, here are the 4 indicators you need to watch starting today. Watch the DXY, the US dollar index. When the dollar weakens, risk assets, including crypto, typically recover. A DXY break below 103.5 would be a meaningful positive signal for Bitcoin and Ethereum. Watch COMEX and CME Bitcoin futures open interest. It needs to rebuild from the current $19.5 billion back toward $28 billion before the next sustained uptrend can begin. Rising OI with rising price is a healthy signal. Rising OI with falling price is a warning. Watch the Ethereum Pectra upgrade deployment date. If it deploys on schedule in Q1 2026, expect a 15 to 25% ETH price response within 30 days of launch. This is a hard catalyst with a known timeline. Watch Hedera's enterprise partnership announcements. HBAR's price will not recover on sentiment alone. It needs a new Tier 1 enterprise integration announcement. The Google Cloud and ServiceNow relationship suggest more are coming. When one drops, HBAR typically moves 20 to 35% in 48 hours. Right now in this market, there are 3 types of people. The first type is panicking. They are refreshing the price every 20 minutes. They sold at $65,000 and are now watching to see if they should have held. Fear is driving every decision they make. The second type is frozen. They know something important is happening, but they cannot figure out what to do. They are waiting for certainty that will never come before the price has already moved. The third type is learning and preparing. They are studying the historical patterns. They are watching the indicators. They are sizing their positions correctly. They are not emotional. They are systematic. They are the ones who will look back at February 24th, 2026 as one of the best setups they ever saw. Markets do not destroy wealth. They transfer it from the people who react to the people who understand. Every dollar lost by a panic seller lands in the account of someone who kept their head clear and read the data correctly. We started today with one question. Why is one institution buying $100 million worth of Ethereum while the rest of the market is selling? Now you know the answer. They understand the mechanism. They understand the historical pattern. They understand what the fear and greed index at 11 has always meant. They are not smarter than you. They are simply less emotional than most. If this breakdown helped you see what is actually happening, hit the like button right now. Subscribe to Market Flux so you do not miss the next move. Because based on the data, it is coming faster than most people think. Share this video with someone who is panic selling right now and needs to hear this. And drop one word in the comments. Type prepared if you are in the third category. Let me know you are watching, learning, and ready. This is not financial advice. Always do your own research before making any investment decision.